Mutual fund, an investing term as ubiquitous as any. But what are they? At its core, a mutual fund is a professionally managed type of collective investment that pools money from many investors to buy stocks, bonds, short-term money market instruments, and/or other securities. And so by that definition, a mutual fund is good for anyone not interested in doing the research to make their own investments. The only thing you really need to know is to what objective you want your money to be invested, whether it's to grow over time, earn income, or even if you're just looking for a safe place to park your money. Generally, they are divided into 4 main categories that can be further divided into other categories, such as U.S. or international. But for the sake of simplicity, let's focus on the 4. Money market funds invest in money market instruments, which are fixed income securities with a very short time to maturity and high credit quality. Investors often use money market funds as a substitute for bank saving accounts, but unlike bank savings accounts, they are not government insured. Money market funds account for 30% of the assets in all U.S. mutual funds. Bond funds invest in fixed income securities. Bond funds can be subclassified according to the specific types of bonds owned, such as high yield or junk bonds, or by the maturity of the bonds held, short, intermediate, or long term. Generally, bond funds are better for investors who know exactly why they are going to a fund and what they expect to get from it. Bond funds account for 20% of the assets in all U.S. mutual funds. Stock or equity funds invest in common stocks. Stock funds are also subclassified according to their investment style, growth, value, or blend/core. Growth funds seek to invest in stocks of fast-growing companies. Value funds seek to invest in stocks that appear cheaply priced, and blend funds are not biased towards either growing or value. Stock funds are by far the type of mutual fund most invested in, accounting for 45% of assets in the U.S. Lastly, hybrid or balanced funds invest both in equity and fixed income-based securities. Basically, they're funds that invest in both stocks and bonds and aim to decrease risk associated with stocks. There can also be mutual funds made up of multiple mutual funds, commonly known as funds of funds. Hybrid funds only accounted for 6% of total mutual fund assets. As with any product, mutual funds have their shares of pros and cons. Some of the pros of mutual funds are that they are professionally managed, hopefully by someone who knows more than you, and they allow you to diversify and invest in many companies. The biggest cons of mutual funds are that the fees are difficult to understand and the investment returns are not guaranteed. There are approximately 7,500 mutual funds in the U.S. The funds most commonly owned by assets held are by Vanguard and Fidelity. These 2 firms are also cited as being the most trustworthy, according to Spectrum Research. So if you're looking for an easier way to diversify your investments, speak to a financial advisor about mutual funds to determine which one is right for you.